Thank you, everybody, for joining us and giving us your lunch hour. And big thanks to Heather for pulling this together, and she'll be navigating through the presentation. I do find the title of the presentation a bit aspirational. We only have an hour, and after 40 years, I'm still learning how to understand financial statements. So we'll give it a shot. As Heather pointed out, reviewing and digesting financial statements is not really for everybody. Not-for-profit financials can be even more confusing. And the YMCA financials are worse even yet. So we're going to flip through a handful of slides that focus not so much on accounting stuff, but more on things that we do here, more on things that we find important to the why. But again, we're only dealing with the tip of the iceberg today. And as fast as we're going to go through a lot of data, we're going to go even faster tomorrow at the executive committee and Wednesday at the board meeting. And to someone's question earlier, that's kind of why we decided to spend an hour on this stuff, because there's just not enough time in a typical committee or board meeting to do justice to some of these things. So a couple of ground rules. First, there are no rules. Interrupt, raise your hand, ask away in the chat room or otherwise. Certainly, any Q&A is going to be more productive than just lecture. So please feel free. And finally, there are no penalties for early completion and dismissal today. Heather, you want to take us to the first page? This page, entitled The Income Statement, is not what you guys see throughout the year. This is what you'll hear me refer to at times as the GAAP basis or GAAP presentation, the generally accepted accounting principle presentation. So things end up on different line items here, both above and below, in comparison to what you guys see on a monthly basis. On a monthly basis, we don't generate management reporting on the GAAP basis. It's more the YAP basis, the Y accepted accounting principle approach. So I'll start at the top. I promise you we're not going to dwell on each line item. Two line items up above within revenues are key to our economic engine, and that's contributions at the top and membership a few lines down below. Within contributions, I'll point out that when we do this GAAP presentation, we have to recognize contributions when they're pledged. When we do the monthly financials for you guys, we recognize contribution revenue when it's received in cash. So back in 2018, you'll notice a substantially higher number. And that's because at Christmas time that year, we received a $2 million pledge that we are recognizing $400,000 per year in the operating fund. In a page or two, we're going to try to reconcile the two different approaches. Heather's second big arrow is on that membership line. Key to our financial health, key to our cash flow. You'll notice that back in 18 and 19, we used to enjoy membership revenue of about $16 million. Due to the pandemic and the shutdown, we're going to be much closer to $11 million this year. We're going to increase a little bit as we anticipate a bit of a reopening of the economy, but not a recovery by any means. So what's budgeted next year is about 70% of who we used to be, about 70% of that 2019 membership revenue, a very modest increase over 2020. If you slide down below, another item that is not part of the monthly financials is that net realized and unrealized gain on investments. And that's our return on our endowment fund. And I'll show you that number in a couple of minutes. Another item that's not part of operations is this bottom arrow, the PPP loan forgiveness. And here's how that works. We secured about $4.3 million in the PPP loan back in April. I anticipate that most, if not all of that, will be forgiven. If it is forgiven, we will recognize a $3 or a $4 million gain. In this presentation, that gain is up above the line or included in total revenues, gains, and other support. When I show you the monthly financials all year, I ignore this number because it's kind of extraordinary. We won't know for a couple of months whether that loan has been forgiven or not. So it could end up being a 2021 event. I'm anticipating that if it gets resolved before we finalize the audit, then we'll recognize it in 2020. So just know when you're looking at any of these years, I don't think it changes the takeaway on how our cash will shake out, how our financial health will shake out, but that gain could indeed happen in the first quarter of next year rather than the fourth quarter of this year.
Hey, Steve, I have a question about that.
Yes, ma'am.
So the PPP loan, the idea was that small businesses kept their employees on the payroll. We did not do that. How on earth are we going to expect that that will be forgiven?
Well, because we did, as long as we have overspent the loan proceeds, and indeed we have spent over $8 million on those things that qualify, 24 weeks worth of payroll and rent and principal and interest. So we will probably be penalized a bit for the fact that we had 1,700 employees in February and only 200 in April. We have started restoring that back, and last payroll we paid 600 or 700 folks. Now, that would normally mean we have to pay some of it back, not all of it back. However, there are safe harbor provisions that would allow us to claim, hey, I know we didn't hire everybody back. We couldn't hire everybody back. We were precluded from operating at capacity. We weren't allowed by the government to operate Camp Ernst resident camp. Our revenue is only half of what it was in the second and third quarter of 2019. So good question, because it's not a slam dunk that they're going to forgive $1 million or all of it. But there's a good chance. We certainly have a good story to tell.
Okay.
So that's how we get a little bit of that back. High level takeaway, we used to be a $40 million entity. We're a $30 million entity in the short term. So there's a lot of different things that shake out on our financial statements as a result. Down within the expenses, because we don't have the volume that we did, we're not going to have the salaries and wages that we used to have. And we'll probably never return to $20 million worth of salaries and wages. If there was one key learning from this pandemic, it's that we don't need the number of people that we had working in our branches. We will be leaner and more efficient once we get to the other side of this. I wanted to point out on that benefits and payroll taxes, because those two lines, salaries, bennies, and taxes, are such a huge piece of who we are. In the year 2020, we are accruing well over $1 million for unemployment for all of those 1,500 people that were furloughed in March and April. Because we are what's called a self-insured / reimbursing employer, we're on the hook for 50% of the unemployment compensation for those folks. So I don't anticipate that continuing into 2021. So you see a big drop on that line, even as salaries and wages inch up. Any questions about that? It really is an important line item as we compare ourselves from 2020 to 2021. We're going to revisit some of these on subsequent charts, so I'll just go all the way down to the bottom. We are currently forecasting to be roughly break even this year, lose a couple $100,000. We are budgeted to lose $2.5 million next year. That's not all cash, obviously, because if you look just a couple line items above, you see $2.8 million of depreciation. So we really don't burn through $2.5 million of cash next year. But for GAAP purposes, we anticipate showing a loss. Any questions about this page? Okay. So this is really how we report things to you and to the management team and to the branch execs all year. It doesn't have any depreciation in it. It doesn't have that gain on PPP loan forgiveness. It doesn't have the return on investment in it, because this is just the cash flow from operations. Furthermore, in contrast with those for-profit financials that you guys have seen, we keep debt service up above the line, both principal and interest. Now, you know, on a normal financial statement, only interest is considered an expense. Principal is not. But we want the branches to be able to cash flow that debt service. So we charge 100%, both principal and interest, to the branches up above the line. So this would tell us, again, we're going to break even roughly before we pay our principal and interest. We're going to lose $1 million this year. And then next year, we anticipate making $1 million and then paying debt service of $1 million and breaking even. Now, I anticipate that this is a very conservative presentation. I anticipate we're going to be much closer to break even than we are to losing $1,150,000. But that is what you're going to see in your budget presentation later this week. And I anticipate that we will do better than break even in 2021 after we pay debt service. But we get no brownie points or gold stars or smiley faces for under delivery. So this is what you're going to see in the big book. Now,
does this make some assumptions, like the program fees are where the biggest change is, it appears? Is that saying that camp is open?
It is indeed, but you're skipping way ahead.
Oh, sorry.
We're going to get to that in a couple of pages. But know this, on this page, if you get to break even at this subtotal, but then you plan to spend any money on capital expenditures, you're burning through cash. So we anticipate, for example, making $1 million, paying $1 million to the bank. That doesn't leave any extra cash to pay for roofs and parking lots and equipment and air purification systems, etc. So we really need that number where it's basically a break even right next to the arrow to really be financially healthy, to really have plenty of cash to cover capital expenditures. That number needs to be about $3 million. And we're not going to be at $3 million in the short term, but we're very liquid and we'll be able to survive that. If Heather flips to the bottom half of this page, there is just as much activity for GAAP purposes below that line that you guys never see on a monthly basis. And this is how you reconcile back to that negative 200,000 and that negative 2.5 million that you saw on the first page. None of this has anything to do with our meat and potatoes branch operations. So we don't bore anybody with this because it's truly outside of their control. You'll see the gigantic depreciation number. I don't agonize over that. That's just amortizing buildings and equipments over their useful life. It's not a cash matter. Down about 2/3 of the way, you see I'm adding back the principal on our debt and the principal on our capital leases. There's a big negative number called Central Parkway building rental. That is what the YMCA proper pays in rent to an affiliated entity, but it's an expense on our books. And for GAAP purposes, it's part of that negative 2.5 million, just like that PPP loan forgiveness gain is a big ticket on the journey to roughly break even in the year 2020. So know this, when you're looking at the monthly financials, there's some other activity that's going on that helps you reconcile back to how the bank looks at who the Y is and how the auditors look at who the Y is. Does that make sense? Those are the two most confusing pages of the 9, I think. Questions? Okay, Heather. So the difference between our balance sheet and others that you've seen is instead of having assets and liabilities or obligations and equity, our equity section is referred to as net assets. Some of our equity or net assets are purely unrestricted, and some of them are temporarily or permanently restricted. Up above, you can see that we're roughly a $70 to $75 million entity before consolidation of some of the Central Parkway stuff that was brought up earlier. As a percentage of our assets, our cash is relatively high. So that makes us actually a little bit healthier than other entities where cash is a smaller percentage and or they're carrying more debt. You can see that I anticipate ending up in 2020 with $8 million of cash, burning through some of that cash, because if you remember, we're going to have to spend some of our cash next year on CapEx. So our cash would go down by $500,000 or more. Down near the bottom of your total assets, you can see that we have property and equipment of $30 million, and that's, I'll come back to the investment, but we roughly have $80 million of CapEx, and we have $50 million of accumulated depreciation. So we have $30 million of buildings and other. That second arrow shows you a couple of big investments. When we embarked on this $30 million tax credit deal in 2016, we had to form 4 subsidiaries to enable us to draw down those tax credits because they're only available to the for-profit sector. A not-for-profit like the Y has no tax obligation, so we can't really benefit from that. Well, that investment in those 4 entities adds up to $11 million. When we get to the consolidated financial statements in the audit, you see that going away and getting replaced by $30 million of buildings. Right below that, you can see that we've got investments of $18 million. That's probably much higher today than that, the way the market has performed for the last couple of weeks. If you add up our cash and our investments, we on a daily basis anymore are at the high water mark for liquidity, meaning we have more cash and unrestricted investments than we've ever had in the history of the Y. And that has allowed us to remain strong throughout this pandemic. And that's going to allow us to remain strong until we get to the other side of the crisis. Our ability to retain cash and not spend it on things that didn't generate a significant return on investment, our ability to not dip into the endowment fund in order to fund operations, that has served us well throughout the last several years. B, that's not necessarily how other nonprofits and other Ys run their business. And that's not how other Ys around the country are conducting business throughout 2020. One high level takeaway from today and everything that you've heard for the last couple of months, we are very balance sheet strong. We are very liquid. We are very secure currently. If we go down below within the liabilities, we simply haven't borrowed much money. We don't borrow money that the business is not going to be able to repay. We could borrow money because we're so liquid, even though we don't generate a lot of earnings. That $12.5 million that you see here, we've got $8.5 million of term debt at US Bank. That includes some debt that we used to acquire RC Durr years ago, debt that we used to acquire the Highland County Y a couple years ago, debt that we used to acquire the Batavia Heights Christian Child Care Early Learning Center a couple years ago. And then it also includes about $4 million related to that Central Parkway adventure. So, and that particular $4 million is likely to be forgiven for a cost of only $300,000 or $400,000. So what happens with these tax credit deals, you borrow a lot of money, and then it gets forgiven after 5 years for historic tax credit purposes and 7 years for new market tax credit purposes. So again,
who forgives it? Is it the bank that's forgiving it? Like who's?
The actual investors, because they have already received over the course of those 5 and 7 years gigantic rates of return. Because if you can figure this, if you've got a corporate investor with a 40% federal and state tax rate, they're getting 40% return over the course of those 5 and 7 years. So they've already made plenty of money on their investment, and then they end up forgiving a chunk of that. We're going to have some of it that's going to continue. A lot of it just goes away. Any questions? Any questions then about our balance sheet? This is one that looks a lot more like what you've seen in the for-profit world. Our net assets are gigantic compared to our total assets. We don't have a lot of debt and payables. But know this, the cash is going to fluctuate based on the timing of things, based on the timing of when you pay your bills, based on the timing of when you collect certain things. The needle can certainly wiggle from one quarter to the next, meaning some things that you think might happen on December 20th, they may happen on January 5th. That doesn't change the overall takeaway in terms of financial health of the Y. Okay? And this one, appropriately enough, is called financial health. Here's something to know. Green triangles are good and red triangles are bad. If you have a green triangle, that means that we are outperforming the benchmark. If we have a yellow circle, we're close but not really killing it. If we have a red triangle, that means we're underperforming the benchmark. We track a number of key financial ratios that YUSA has indicated should be important to us. And then we have another handful of ratios that we track because we think that they're important. You've heard me say probably that at the Y, we are cash rich, but we are cash flow poor. We are cash and balance sheet rich, but we don't generate a lot of earnings. We're not supposed to. We're a not-for-profit. We don't generate a lot of surpluses. So any of the ratios that are based on the balance sheet, any of the ratios that are based on cash and investments, we're always going to fare very well. Any of the ratios that are based on earnings, anytime you see EBIT here, earnings before interest and depreciation, the Y doesn't generate a heck of a lot of earnings. We're certainly not going to generate a lot in 2020 and 2021. So anything that has EBIT in the denominator is going to look like it's underwater temporarily. I say temporarily because I'm confident that none of these numbers will look as challenged going forward as they do in 2020 and 2021. And none of them are going to be as bad as I'm showing here. I think we'll outperform a lot of these. Down at the bottom half, I would call your attention to those last two red triangles. And coverage of capital costs means after you look at those surpluses that we see from operations, are you still spending more than that on capital expenditures? Well, yes, we are, because we anticipate spending about $1.1 million or $1.2 million this year and $1.3 million next year. Well, in the perfect world, you wouldn't be spending money on capital expenditures if you haven't generated some surplus in the operating fund. Now, you still have to fix those roofs. You still have to fix the locker rooms and the lobbies. So temporarily, we are going to be negative in that equation. Not terribly uncommon for a not-for-profit, not terribly uncommon on a temporary basis for a for-profit entity. But when you see this chart, zoom in on anything that's a red triangle and ask yourself or ask me what's happening there. At the same time, on that last line, you wouldn't like to have a lot of debt if you don't have any earnings. Now, we are not a borrower that depends on earnings because all of our debt is cash secured by either the cash balances or the investments. As long as we have $18 million of endowment and $8 million of cash and only outstanding debt of $13 million, we're not in any particular area of concern. But in the perfect world, you wouldn't have any outstanding debt that's more than about 4 times your earnings before interest and depreciation. If we're going to have negative EBIT next year, well, of course, you're going to get a red triangle in that box because we're going to have debt of 12 million and no earnings. Again, these are benchmarks, not absolutes. They differ for every single company. Because we are so liquid, the red triangles that would cause some people concerns don't necessarily cause concerns here at the Y. But again, remember the comment a page or two ago, we need to start generating about $3 million in the operating fund so we can cover not just $1.3 million of CapEx, but a couple $1 million more because there's certainly no shortage of need. You may have heard me say that we have a bunch of buildings that are 50 years old and they all turned 50, I think, on the same afternoon. So we have a lot of infrastructure need. We need to get $3 million in the operating fund. If we did, all of these triangles would be green. Any questions about this confusing chart?
Is there a fund somewhere, and maybe it's part of our investment money, where we sort of sock away for capital needs?
Not really, other than what you saw in cash in the operating fund. Now, having said that, we've got $18 million in the endowment fund. Almost all of that is quasi endowment or unrestricted. It got designated by the board. Any of that really could be used as a rainy day fund. We would prefer to let it build up rather than dip into it, because we have been able to largely fund CapEx from operating cash flow. So there's no specific designated or restricted fund for CapEx, except what you saw on the previous page in terms of cash and borrowing capacity. In addition to the debt that we've got on our books, you guys should know that we have a revolving line of credit of $1.5 million that we've not drawn on. So if we ever needed $1 million, there's a number of places to get it.
So on the endowment, the 18 million that's invested.
Yep.
I know some endowments, they pull a maximum of 4% a year out of that or something like that. Do we have any kind of rule like that?
Yeah, the policy is up to and not exceeding 5% of the rolling 20 quarters of market value. But what we've done for the last couple of years is only dip into those individual endowments where the yield is restricted to fund a certain program. So instead of taking $750,000 out of the endowment and moving it into the checking account, we only take out about $100,000 for those specific programs and scholarship arrangements. Again, we could take up to $600,000 to $800,000 every year. We're certainly thankful, given a couple of years that we have had in the market, that we didn't do that. Our endowment fund has more than doubled from the beginning of 2009 till today.
Wow.
And again, I think we're going to end up being well served by not having dipped into it. It's there as a rainy day fund, not an everyday fund. Unfortunately, a lot of nonprofits around the world, it has turned into be an everyday fund, and it collateralizes our borrowings and allows us to go borrow money. And as cheaply as we could borrow money these days, having a gigantic endowment fund is better than dipping into it.
Okay.
Again, one high level takeaway from this page is no cash flow, no mission. You still need to get positive cash flow in order to fund everything that we want to do. Any questions about this guy? I'll offer, I suppose, this one is just as confusing as the two before it. So. All right. So here's an interesting chart. If you guys are paying attention, you see it on a monthly basis where I break out the major components of our revenue. The mix on this page goes a long way towards our bottom line and the financial health of the Y. Membership dues, again, our economic engine, accounts for about 38% of who we are. But the next two large components, public funding, which is government money, vouchers, 21st century grants for school-age childcare, and then program service fees at 36%, those don't generate the same type of margins that membership and contributions do. They're much more labor intensive. We're always healthier to the extent that membership dues are 40% or higher of who we are. The reason that the YMCA of Greater Cincinnati and YMCAs around the country have experienced a shift in the mix here is not necessarily because they tried to do it. They didn't necessarily want camp and child care to comprise, as it does in our world, 50 to 55% of who we are. It's just that's how the world evolved. You're much healthier with membership being higher than those other two. While we're here, we'll talk about a question that came up a little bit ago. You'll see that we're counting on program service fees going up between $2 and $2.5 million. 1.7 of that is really just the operations over at Camp Ernst. We really didn't have hardly any revenue over there except for some day camp. We are not anticipating a return at Camp Ernst to the way we did business years ago, but we are counting on some recovery. We are counting on being able to operate, albeit with social distancing rules and capacity containment and curtailment. It looks like a gigantic leap. You'll see in another chart or two that Camp Ernst is driving that, a little bit of recovery on a couple of other lines. But again, except for Camp Ernst, which is fairly lucrative and fairly profitable in the typical year, the rest of program service fees and public funding, it's just childcare. And a childcare in many ways funded by the government. It's hard to charge enough to cover such a labor intensive component of who we are. So I don't know if everybody appreciates that we are far from just a gym and swim business model anymore. 50 to 55% of who we are, you could call childcare. Little bit of adult programming, but it's mostly camp and childcare, taking care of our youngest customers. Any questions about this page? All right, so one of the reasons why we anticipate modest growth and maybe not as significant as you might expect is because we have discontinued membership operations at 3 of our branches: CHL, Duck Creek, and Richard E. Lindner in Norwood. Those weren't big branches, obviously. They only had about $300,000 of revenue, and at least in 2020. And while you would like to think that we could retain those members and shepherd them to another location, because we have so many branches around the greater Cincinnati area where they could work out, a lot of times when you close a branch, you lose those people forever. It's unfortunate, but we're not located necessarily where they are. I think that we had too many YMCAs for our service area. They weren't necessarily in the locations where anybody on this call would necessarily drop them in. So while it looks like we only anticipate growing 4%, we also have to recover from the loss of those closed branches. I don't think any of the numbers here are going to be difficult to obtain, but you guys don't get to see a lot of the detail by branch information. And we can act like we are all one happy family, one consolidated entity, one Y. The reality is individual fluctuations and variances by location are real, and each community is a little bit different. We have a lot of Ys that are too small. Most YMCAs around the country, that are 30 or 40 million dollars in total revenue and 10 or 15 million dollars of membership revenue, they only have a half a dozen branches, because you would like each branch to have membership revenue of well over $1 million and total revenue of well over $2 million, or you're simply not going to be able to operate at a profit. If you don't have 2,000 membership units at least, you're going to struggle to break even. So it is relevant sometimes to look at some of our data by location.
Steve, is that a philosophical change that's occurred over the last couple of years to make every Y facility profitable?
I think yes, because we could afford to look at it the other way. It's now to the point post-pandemic, it really is not responsible to operate properties that lose a significant amount of money. The surpluses at the branches that used to be cash cows, Blue Ash, Clippard, Lyons, and RC Durr, yes, they remain profitable, but not as profitable as they used to be. So we can't afford to do everything that we used to do. And it's not just on membership, it's throughout the business model. I think that every community deserves the YMCA that it can afford. We don't abandon communities until those communities abandon us. When you look at some of this membership revenue, you can see we clearly weren't the most relevant business option for those communities. We weren't as competitive and relevant as other activities. So again, I think that we ended up with branches where people gave us land or buildings, and not necessarily on major thoroughfares where they could compete and be successful. So we ended up with 12 to 15 branches over the last 10 years. Greater Cincinnati could probably support a number half that size.
Okay.
Program revenue, which goes back to an earlier question as well. And what will jump out at you here is how significant the Camp Ernst recovery is. Again, we're not planning on getting back to the glory days, but we're also not planning to be shut down all summer. Big deal to the Y's financial health, because we thought that Camp Ernst was going to generate $500,000 of surplus in 2020. They're going to lose $500,000. That is a lot of why we operate in the red this year, before those extraordinary items like the PPP loan forgiveness. We're really not counting on gigantic recovery at any of our other locations. I know that there's sometimes some confusion about what ends up on this program line, and that's why I break it out down below. And you can see that youth sports and recreation and aquatics, which is primarily swim lessons and swim team fees, they're a relatively small piece of our program revenue. Our program revenue is childcare and camp. A lot of the other activities that you see in our buildings, those are free Group X activities. We don't charge for much other than childcare, swim lessons, and youth sports.
What's causing some of these, like Blue Ash and Campbell County, to actually go less than 2020?
Primarily terminating childcare operations that weren't making any money.
Got it.
So They discontinued some school age work that just wasn't breaking even. They now have benchmarks for all of their operations where they shouldn't conduct a program that doesn't make a 20% margin. So they had activities that didn't. And that's across any of these. If you see a branch that's going down from where they used to be, it's all childcare sites.
So we don't, and maybe it's not in this category, like when we're doing mission things that don't have any revenue associated with them, they're obviously not going to be profitable.
Right.
We don't think about childcare that way.
We do. And I think that that's why we still are going to have $9 million of this activity out of 30 million. It's certainly mission work. And as long as we have a healthy mix on that pie chart we saw a little bit ago, as long as we have enough contributions and enough membership, we'll always have a gigantic amount of who we are on this page. It's just that it's a more delicate balancing act than it was in 2018.
Yeah. Okay.
And again, I think a big piece of this, the story of some of those activities that you bring up, the message of delivering essential child care in these communities should enable us to raise money to support those activities that don't pay for themselves. Historically, we have not raised enough money for the typical 30 million or $40 million YMCA. We really need to be raising $3 to $4 million a year so that we can continue to fund the things on this page. And then I think we probably would be in a position to retain and not have to throttle some of the things that we did here on this page. But again, we can't do it until we raise more money or until membership recovers more than we anticipate. Look at some expenses. Your takeaway here is that some 75% of our revenue dollars are spoken for in terms of salaries, bennies, payroll taxes, and occupancy. And occupancy is really just debt service and utilities. So we have to be smart about where we spend the rest of our money because so much of it is right off the top. Margins in this business are so razor thin. We have to, in order to compete, make sure that those salaries, wages, and bennies and payroll taxes stay below 60% of revenue. You've all seen some productivity ratio charts, and that's really just compensation divided by revenue. We've long tried to beat the 60% benchmark. In this day and age, we have to do even better than that. So next year, we anticipate being 56 to 57% of revenue in the productivity ratio. Very, very key to financial health. Maybe the most important key performance indicator and measure of our success. But this pie chart also tells you you're not in a position of going out and borrowing a bunch of money and paying a bunch of principal and interest, because there just isn't that much. This spending, although I think that it's conservative for what we're going to need to get through 2021, and I think that there are levers here to activate should revenue not materialize. And if one of these line items runs a little bit hot, I think we've got cushion in a couple of different places to make sure that we can deliver this budget, because a budget should really be deliverable 8 out of 10 times without some act of God. Although we certainly count on that most days of the week around here. Any questions about this one? Again, file away somewhere in the back of your mind that compensation plus occupancy, 75% of who we are. So we have to be smart about everything else. So back to what we talked about before about why it really makes sense to see a couple of individual silos versus just looking at the consolidated picture. This shows you how we get from losing $1 million in 2020 to breaking even next year by branch. You can see that we've got some challenges. Admittedly, we don't try to be extraordinarily profitable at each branch, but we have to make money some places to offset what goes on. How do we get from losing $1 million to break even? If we're able to deliver on these individual branch numbers, it's not that complicated. We close Richard E. Lindner in Norwood. We contribute that building to the city of Norwood so that they can use it as their community activity center. We don't lose money there anymore. And it's a matter of addition by subtraction. We pick up $125,000, not just in 2021, but for the next 100 years, because that property was not ever able to be profitable. So it gives us an annuity going forward. Same story down on Melrose. We have mitigated our exposure at that property over the last couple of years, meaning we used to lose $250,000. We're going to be much closer to 100 or 150 this year. But if we are able to sell that property to Easter Seals, there's an improvement in next year's budget of $130K over where we're going to end up this year. Some of you have been involved in that vote to approve that transaction. I think that we'll have it memorialized or papered by the end of the year. I think it'll happen by the end of the first quarter. Youth development and education, it's where a great deal of our non-branch specific childcare is. By itself, you can see that it generates almost $6 million. It doesn't make any money. You can't have too many $6 million branches that don't contribute to the bottom line. And you certainly can't have a $5 million branch in 2020 that loses $200,000. We're really not budgeting anything particularly heroic, but we're budgeting a bit of a return to normalcy where we can break even on all of that activity. That means there's a $200,000 improvement just at that one branch from where we're going to end up this year. And right below there is the number that we've discussed. Camp Ernst is not going to lose $500,000 next year. They're going to break even. So that's a $500,000 swing. If you add up those four fluctuations, they account for almost all of our improvement. So you can look at things on a consolidated basis and rationalize we're doing enough on a consolidated basis. You still have to look at this detail by individual location, by individual silo, or we're not going to get there.
What is youth development and education not connected to a branch?
It's where a lot of the public support and voucher money for school-age childcare, 21st century activity, where the school systems can't handle that. We secure grants in order to do those operations. It also includes standalone early learning. We have an early learning center in Roselawn. We have an early learning center in Batavia, an early learning center in Coleraine Township. And all of those are under the sphere of influence of this particular group and not managed at the branch level.
Okay.
Some of the activity is identical to what might be done out at a school and managed by branch management. A lot of it is done under the auspices of YDE or youth development. So.
Okay. And I'm going to have to drop off also. How much longer do you have?
That brings us to the end of Heather's 9 slides. We weren't really anticipating being able to issue CPA certificates after this hour.
Don't test us.
But I think you're going to be drinking from the information fire hose at some of the board meetings where you get to cover a lot of this detail in 5 minutes. And our objective was really just to open your eyes to a couple of the moving parts, not in any way to make accountants out of all of you.
It was really, really helpful. Thank you for walking through it.
Absolutely. Thank you very much. Very helpful.
All right.